All right. Hi, everyone. Thank you for joining the session today. My name is Kun Peng. I'm currently pursuing a Master in Management Science Engineering degree at Stanford University. Also the Vice President of Stanford Blockchain Club, and also the founding director of Stanford Blockchain Accelerator Program. So we're trying to create a cohort of crypto native entrepreneurs on Stanford campus, and to incubate them in a more crypto native way. That being said, today it's a great pleasure to have Tarun Chitra, CEO and founder of Gauntlet, to join us today to discuss about tokenomics design and risk management on the DeFi space. That being said, I will let Tarun to do a brief intro of yourself.
Hey, for sure. Yeah, thanks for having me. Happy to chat with everyone at Stanford. Yeah, so I've sort of been in and around crypto probably for more or less like 10 years. But the long story short is I used to work in hardware at a place called D. Shaw Research, and in 2011, some Bitcoin miners front run us on building some hardware, and that was when I was like, okay, I got to actually understand what this is, because people don't just spend $25 million on hardware for no reason. And of course, now that looks silly. That might be a very tiny drop in the bucket, but at that time there was no one really building custom silicon, so it was a very bizarro world. But then I sort of, after that, I worked in high frequency trading, doing sort of simulation based research on different types of trading strategies, and that sort of led me to starting to realize that as crypto systems started to get a lot more complicated in 2016, 17, people hadn't quite figured out how to bridge a lot of the knowledge known in quant finance about thinking about pricing these things, and thinking about how security is tied to the price of different assets. And so that's sort of how I ended up starting Gauntlet, and effectively try to take the tools that people use in sort of AI and in quant trading to help kind of parameterize these protocols, and also like be able to help adjust things when things change, when market conditions change a lot. And I could give a longer background on Gauntlet, but I think that hopefully via the questions that Kun had, you'll hopefully get a little bit of a picture. And I also do some investing out of a tiny fund called Robot Ventures. It's me and Robert Leschner from Compound. So, as you're building stuff, keep us in mind.
Yeah. Thank you for the intro. Definitely, we're actually talking with you guys for potential investment opportunity into the startup incubate, but also potentially like helping some of the startups in our incubator accelerator to design their tokenomics models. So definitely, thank you for the intro. And I think you guys, like Gauntlet and also Tarun, you have a lot of experience, right, in mechanism design and also on the risk management aspect of DeFi, which will be a great kind of for us, the topic we have today. That being said, we can just dive into the conversation. So how we'll do is we'll spend like first portion of the event on the tokenomics design and some of the consideration when some of the founders in the Stanford ecosystem want to design their tokenomics, we need to consider. And then if we have time, we can also spend some time on the risk management piece. And then we'll open the floor for questions. So if you have any questions, throw them to chat, or think better, it's like raise your hand, so we'll unmute you and you can ask your questions. So that being said, okay. That being said, we'll start the first question. So I think the mechanism design is like using some economic incentives to reach some desirable outcome or objectives in a strategic settings, assuming the players are rational, right? That being said, the objective is super important, right? I think some of the common objectives, desirable common objectives are like boosting participation of addresses within the ecosystem or protocol, or like boosting the TVL, right? So do you think those are like good objectives? If not, what other objective people can have in mind in designing their tokenomics? And if they are, what additional they should also consider when they design tokenomics?
Yeah, I think one important thing to remember is that there's always sort of a good Hart's law effect to designing objectives that are used in production, where once something becomes the metric, obviously people start optimizing towards it. And then at some point, it might not be a good metric anymore because everyone has over optimized towards that metric, and sort of things that are sort of orthogonal to it were orthogonal at the beginning, are now actually somewhat important as features and things you're optimizing for. So, if we take a sort of historical look as to why TVL became sort of a very big metric, is in 2018, November 19th, 18th, I forget exactly what day, but the day that Uniswap launched was mainly to kind of provide liquidity to the MKR DAI pool. And one of the reasons for this at that time was that no centralized exchange was willing to list MKR, which is the maker token. And but it was very important for the stability of Maker's stablecoin that there existed a ton of liquidity for people to trade ETH to DAI and trade Maker for ETH and Maker and DAI. And at that time, the biggest thing that you could kind of say was that the security of the MakerDAO protocol in a very bad event depended heavily on the amount of liquidity that existed for a shock. And so in that sense, TVL is the most important metric. It corresponded to the total amount of liquidity of DAI that existed, so that if liquidators did actually have to buy DAI, they would have a way of doing it. And the second thing was that, now everyone talks about the curve wars, but in the earliest days of DeFi, so like probably late 2018, early 2019, it wasn't really clear that on-chain lending, over-collateralized lending would work. There was sort of this war between Dharma and Compound at that time. And one thing that became very clear was that, there was definitely a liquidity effect for on-chain lenders, where the more TVL you had, the more sort of flat interest rate curves you could offer. And the flatter the interest rate curve, sort of the cheaper it is for borrowers at larger and larger size. And so there's sort of this liquidity begets liquidity effect in on-chain lending. And so in sort of, January and February 2020, we had seen like the whole kind of the 12 months of 2019 lead to this thing where TVL was actually really important for security, but also for user acquisition for those protocols, right? So it's very specific use cases. I actually gave a talk at the Stanford Blockchain Conference in 2020, and I remember I showed the chart of like the compound TVL in my talk, and everyone in the audience was just like shocked that there was $200 million in this thing. And so to give you an idea, like TVL was started as this metric that was related to security and user acquisition. Now, of course, it's clearly not the only metric that should matter. And over time, it has become much more clear that like for some protocols like Uniswap, you probably don't really want to have too much capital sitting there resident at all times. But you want it to sort of have some just-in-time capabilities of like when you need capital, you can call it. And versus lenders actually do, TVL is actually a pretty good metric, relatively speaking, compared to AMOs. Now, I think for a lot of new protocols, I think once Compound sort of invented yield farming, you could really argue that Synthetics invented yield farming. in like April 2020. But I think the time when it became sort of a growth mechanism for new protocols, that sort of, which started off the whole kind of growth of DeFi Summer, was really from Compound's June 2020 farming initiative. And the thing I guess I would say is that a lot of people just started, like, for better or worse, right? Most projects do not write their code from scratch. There's great reasons to do that. Audit surface goes down, etc. But one thing that gets inherited is people inherit the metrics of other people's code, whether they implicitly meant to or whether they explicitly meant to. And so that led to DeFi Summer being really driven by TVL as a metric, even though TVL was a metric that was really for Compound, Maker, and Uniswap. And suddenly everyone else started kind of copying it. And I think that kind of is the Goodhart's law effect at hand of like, it's a good thing for a certain use case, but then it kind of got used for everything. And it clearly is not necessarily the correct metric for everything. So I guess the main thing to think about when designing these things is like, before even kind of getting into what metric to choose, the first question you should be asking yourself is what is the protocol's revenue, and like what is the source of cash flow? Because if it's a protocol that has like no cash flow, like a lot of NFT protocols or a lot of things that call themselves DAOs that aren't DAOs in the traditional sense, I would say that you should basically be optimizing for things that are some type of usage, customer acquisition type of cost, and not just like, hey, can we get a bunch of assets sitting here? And on the second, you go down this decision tree. Do we have cash flow or not? Okay, no cash flow, pretty much just optimized only for customer acquisition. And so I think a lot of the OpenSea vampire attacks we've seen recently, you could argue that they're sort of one vein of doing that. I think the now down the other side of the decision tree of, yes, we have cash flows, like we're a DeFi protocol, we have revenues, there's fees, there's some type of like treasury that's being accumulated. Then the next question is, how much do you want the treasury to be actively managed, and how much do you want it not to be? Because if you want it to be actively managed, then you need to make sure that your token design does kind of encourage either voter participation or some type of like asset locking program of people contributing assets to the treasury, or like, lending to the treasury in some sense. If you want it to be very passively managed, then you probably don't need to incentivize much more than sort of revenue growth and sort of customer acquisition type of costs. So like paying for developers, paying for kind of like UX marketing like a normal company. And then you go down the rabbit hole of, okay, if we're actively managed, how much risk do we want the token holders to take versus how much risk do we want protocol users to take? And deciding on that split will decide a lot of your economic behavior. So like a lot of this stuff, this is a very nascent space, and it's not like everyone knows exactly what to do. And a lot of what you see is like things where people just try some experiment and it maybe works or it doesn't. And then, over time, if you've been around for long enough, you kind of have this little compendium of like which things worked, which ones didn't, how they worked, how they didn't. And it's just has not sort of past the oral tradition mark yet. There's not sort of like a formal theory for this type of stuff. I think there's starting to be some sort of results like that, but I do think, even this decision tree I just said, right? Like that's my framework for it. That's not like written down somewhere as like the playbook, but that's sort of like roughly how I view it. And I think one important thing is to just think about those different facets, especially because at the end of the day, right, the token exists because it's the value of managing a treasury in some way, shape, or form, right? And whether that treasury is spent on customer acquisition versus revenue growth versus sort of new user initiatives like new features, that playbook really depends on the actual protocol itself.
Yeah, definitely. Thank you for the insight. I think the decision tree is actually a good framework for people who are actually not very familiar with tokenomics design to have some like initial step or framework around which they can consider. Like maybe like as you said, TVL might not be the only metric they need to over optimize for, right? There's so many other things depending on the specific scenarios, but the framework is definitely a great starting point for them to start to consider there's something else other than TVL, right? Given whatever they're doing, Lightning protocol or NFT or DAO. Great.
Yeah, for sure. And I will say again, this stuff changes over time. Like I wanted to give the historical view of it because I think at that time, one thing to get totally clear is that TVL growth was extremely important. It was like basically the only thing important in 2019. And so for both risk and for customer acquisition. And it's just like, it's good to understand that sometimes the metrics you've heard of are the metrics of yesteryear, right? Like they're kind of like lagging indicators when they grow. Like the market has already sort of picked that metric and optimized for it. So if you are trying to think of like a new metric, just make sure you kind of war game it against the ones that exist, and then kind of like try to understand why certain ones existed and why your metric might actually be the correct one to optimize for.
Yeah, makes sense. So about like the metrics, right? I think there's another when they design the tokenomics, there's another things like governance model, right? About all the governance use scenarios of their tokens. But regarding that aspect, what are some of the key areas to keep in mind, right? When designing governance, being like metrics or being something other than metrics, right?
Yeah, I mean, I think the question is really, what are you actually trying to govern, right? If you're governing something that has economic value, then it's very different than governing something that doesn't really have economic value. And I think in DeFi, it always ends up being tied to economic value. So you can actually ground what the point of governance is, right? Governance is to reduce risk. Governance is to increase revenue. Governance is to, execute buybacks, things like that, right? And we've already seen that get automated in a way that in traditional finance could never happen. Like the idea of the curve wars and other protocols accumulating governance tokens to go change parameters. Sure, that happens with activist hedge funds, but it's not automatic. It's not like there's like, the activist hedge fund has to go to a broker, tell the broker to buy a bunch of shares, then they have to go tell the shares to go vote. And then once the vote happens, the board has to go like tell the company to go do some action. And there's tons of humans in the loop. In DeFi, we basically recreated 99% of that with virtually zero humans in the loop, which is like incredible. And I think convex finance and Ohm and stuff are clearly showing that like you can bootstrap governance off other governance tokens if there's real cash flow. On the other hand, I think one of the reasons people have a lot of consternation and there's all this infighting and kind of muckiness in other types of DAOs is that other types of DAOs are inherently political. They're much less like revenue generating is, the bottom line. And so I think in those types of situations, governance needs to somehow have a metric a priori beforehand that matters. Whereas I think in things that have revenue, you don't actually need to have the precise metric up front, right? Like it might actually be, hey, we want to maximize revenue really early, but then later we want to just minimize risk, or sort of, some type of something that's very related to like the treasury, accumulation. But in an NFT community, it's extremely different, right? It's like, well, okay, this NFT community has some set of values that we care about upfront. We've stated those values explicitly, and governance is meant to uphold those values. That's sort of the abstract framework for what NFT communities are supposed to do. Now, the problem is that inherently will eventually lead to conflict because people will say this value is not really my value anymore, or like this community has strayed from this value. And I don't really like these like sort of non-quantitative DAOs are extremely hard for me to totally personally understand, because they're just, what are they? That's just a social club, right? At least at a high level, it feels much more like a social club than like a technology or a finance instrument. So I think in those cases, governance just needs to be extremely clear, and probably for a lot of reasons should start somewhat more centralized and have like a multi-sig or like a small set of individuals involved, and then have some sort of formal process for elections, because it is at the end of the day much more like politics, whereas DeFi is much more like shareholder governance, shareholder activism, and like there it's much more clear that there's a lot more room to play with mechanisms, right? Like your governance mechanism, you might launch a governance token and then someone launches another mechanism that drives value to your governance token. Then like the curve and convex finance thing is a great example of that. Whereas I just don't see that happening with the NFT community. Like, is someone going to build Bored Apes Probably not, right? Like what would it do? It like the Bored Apes governance doesn't really mean anything in some sense other than preservation of aesthetics. And so, yeah, long story short is I'm probably the wrong person to ask about NFT governance because I just don't really get it. Like it just seems like normal politics, but
yeah, thank you for the answer. Yeah, I think we like a governance model or very well designed governance model can help like the project kind of have like keep the user engaged in the long term, right? And also a good tokenomics model will have the right incentives also to keep the user engaged or maximize certain metrics or TVL, like the first question we asked. The second question is governance. But all of them seems to be like more kind of tailored towards the long term, right? Being able to keep user engaged or have the TVL. But what about like the short term, right? Does tokenomics or governance matter that much in short term, especially during the token launch?
Yeah, so I would say it's one way it does matter, and this is a lot of the places where the network effect of DeFi protocols comes in that doesn't really exist as much in normal companies, is that a lot of new protocols end up, thanks to sort of the composability of crypto, end up integrating with other protocols, right? So you have protocol A, and it sort of depends on protocols B and C, and it drives volume to them. And so maybe protocols B and C earn protocol A's token, and protocol A earns protocols B and C's token. Well, that's in normal world, that's impossible to do. Like the US government is not very easy, doesn't make it very easy for one company to pay another company in equity. It actually is like a lot more legal work, right? Whereas here it's like, okay, well, you're using my protocol, I'm giving you some of my equity. Equity equivalent, of course. Not a lawyer, I'm not trying to make some claim about securities. But the idea that there's this kind of network graph of all of these protocols interacting, the more you matters, because it's sort of like that will drive the synergy between this existing thing that maybe has their token being used and is generating revenue and your new protocol. Whereas if you're kind of a new, very new piece, like atomic in some sense, like you don't really depend on other protocols explicitly, then it probably matters less. So that would be one place I would be very careful of distinguishing. Like if you're bootstrapping, so you're making a new lending protocol that relies on SushiSwap, for instance, so you're earning SushiSwap rewards, then you do have to think a lot about it, because your token is now sort of has some sort of implied value from sushi, right? And that's where the finance, at thinking of this from a like financial lens, like a quant finance lens, is kind of very important, right? Because you're sort of like treating your protocol as like this basket of options that can be liquidated partially for some of these other protocols assets you're using, and then partially for your treasury, which is why you have to care more upfront. When it's just for your treasury, well, your treasury hasn't grown, right? So there's kind of that distinguishing thing. And again, I would say from the perspective of user acquisition, I think it might, like for like these NFT type of things, like kind of like especially these vampire attack style things, like looks rare and SOS and stuff. I think there it matters a lot because you know you need to prove that your thing has more value than the existing thing by like a certain amount for a certain amount of time, right? If you're really trying to steal other protocols users, and there you really do have to be careful. And I think one interesting thing there is this question of how much do you play with temporal aspects of tokens, like lockups, vesting, slow, sort of like slow increases in how much people earn, which you know are more stable for your protocol, but will be hard to convince users who just like sort of want to migrate as easily, versus kind of fully liquid, so people migrate but then they dump your token and then never come back, right? And so I do think for things where you're trying to vampire attack and steal users from other protocols that are similar, you do need to think about things a lot. But if you're building, say, like a completely new DeFi primitive that has nothing to do with any other existing DeFi primitive, doesn't look at all similar, then your economics don't matter until your treasury is big enough. That would be roughly what I'd say.
I see. Yeah, it makes a lot of sense. So I think you have a lot of experience based on the talk, like tokenomics, and like basically there's so many different types of projects, and probably they have to have different considerations when they design their tokenomics. And you probably have already worked with a lot of projects, their tokenomic design, incentive design. So what are you like? What do you think? What you have seen some of the common mistakes people make when they design their tokenomics?
Yeah, I think one thing you often saw, like maybe again, I'll give the historical view on this. In 2020, I think the thing you saw was the fair launch, which is that there's no token allocation to the developers or team. And the fair launch was extremely mercenary. So like you had really high inflation, and the earliest users basically took everything and then kind of never shared with future users, especially when there was no inflation. And then we saw sort of this evolution to like, hey, like maybe VC isn't the worst, so like we should have some developer allocation. And also it was funny because like the fair launch was like, oh yeah, we're like letting every user use our stuff, but like it's like, and there's no VCs, but it's like, well, anyone could just put capital and farm these things, so it wouldn't be that different than if you had a VC, except you have no rights for the developers. But I think the more kind of salient thing that happened over time was that people started, you know, kind of having these sort of treasuries that the governance token held. So you started seeing the tokenomics split between the developer portion, the kind of like farming rewards for new users and customer acquisition, and then the protocol owned sort of liquidity aspect, which is, you know, like assets that the protocol owns that it would go actively manage in different ways. And I think one sort of mistake that often happens in this world is being too kind of clever or aggressive with the protocol owned liquidity component. You know, one thing that's interesting, of course, is that DeFi means that anyone and their mom can use very complicated derivatives with very low capital costs. But one thing I think that's interesting is like, you know, we haven't come up with a sort of debt capital finance structure that looks like normal companies in this world. And so people instead will start using kind of complicated derivatives on their treasury. So they'll borrow against their treasury, get leverage against their treasury in like very complicated ways, partially to like provide higher APY looking yields, right? Even though it's not really risk-free, right? Like they're implicitly getting leverage against the treasury, using that to pay out rewards to buy new users. And one thing that's interesting with that is like that leads to this kind of really bad hyperinflation curve. And then you can never make up for it, especially if you get liquidated. So I think like being not jumping to financial engineering until you have like a treasury that is actually does really benefit from it, like a few $100 million or something like that, is quite important. The other thing that's important to remember is like if you go down this route of being an actively managed treasury, most DAOs, if they actually have a real community, are not going to make 500 million decisions. And like they're not going to be like a trading firm constantly shifting their kind of like allocations. So you need to be very careful that you design your active management in such a way that you don't need that much governance intervention, right? Like your goal shouldn't be to like maximize governance intervention. Your goal should definitely be to minimize it as much as possible. But it has to happen, right? It's still managing the, it's still kind of asset management, and that inevitably has such a thing happen. But yeah, roughly speaking, I think that's one of the things I've seen is this idea of like giving away liquidity too fast. So A, B, being too clever with active management strategies. And then C, I think, is not rewarding contributors enough. I actually do think DAOs probably, and they have been increasing quite a bit lately. But I do think like DAOs are just companies without the leisure of like the C Corp or LLC, right? So at the end of the day, they're going to eventually have some form of hierarchy, whether you want to explicitly call it out or whether you want it to implicitly foment over time. But I think that, making sure contributors are rewarded and making sure the mechanisms for that are there is quite important.
Yeah, I start to see people raising their hands. So if you have a question, feel free to raise your hand or open the floor. Pretty soon I have probably try to have only like a question or two, and then open the floor for questions. So yeah, thank you for sharing with us like some of the framework that people can start to think about or use to when they design their tokenomics and governance. So what are some of the good like materials or classes or podcasts or maybe interesting theories that people can read or study to get more familiarized with this subject?
Yeah, I mean, for better or worse, the only places really are going to be governance forums where people are debating this stuff. I mean, a lot of it does happen in Discord and whatever, but I actually think the forums forcing people to write long form posts is really where a lot of that happens. Some of it at a minimum de minimis level is in some academic research, but it's not quite at that point that's true. I really think the governance forums for the big protocols are extremely good places to look. So like for Maker, Compound, Aave, Uniswap's a little crazy, so I would advise not getting lost in the fact that there's just a million posts asking for another airdrop in there. But I think like the resources are quite limited right now, to be honest. And like I think a very viable kind of academic type of thing for someone to do is to be like a digital anthropologist and like go through all of the stuff that's been created in this world and cataloging it and make a sort of like review article or like even like a light like sort of small book, because it is all public. Like at the end of the day, the data is public. It's just like no one has bothered doing, like obviously there's money involved. People would rather go make more money instead of do the sort of cataloging retroactive sort of thing, but it is all there. And I just don't think that people, there's not really a lot of stuff podcast wise. Like, I mean, I will shill the podcast one of the podcasts I co-host, which is the Zero Knowledge podcast. I think we do cover some of these things, although we're way more focused on like the technology side of things, but we do cover some of the economics. But I think it's not just an interesting thing is you ask about podcasts, and a lot of the tokenomics design is done by anons nowadays, and a lot of them do not like to do podcasts or Twitch or things like that. So I think the pseudonymity piece actually to some extent hampers how much is publicly like curated, and that's an interesting thing about this space that I don't think has been, you know, quite evinced quite as much.
Yeah, thank you. The last question I have is about, since we spent quite some time talking about mechanism design or incentive design, is more on the risk management side. So I think composability is a great thing, right? You have a lot of, you can compound a lot of interest built on top of each other, but also it's like double-sided sword, right? So you have also the flip side, which is like compounding the risk, right? So in the absence of monetary policy measures and like protection in the DeFi market, what do you think some ways like DeFi protocols can potentially mitigate risks or exposures given the composability nature of DeFi? Say if there's a crisis happening or some major protocol they rely on got hacked.
Yeah. I think at the end of the day, none of this stuff is static. So I feel like there was this belief in the early days of DeFi that like you would just write a protocol once and you would like set it and forget it. It would work forever. And, you know, to some extent, you could argue Uniswap V1 did do that. It's still live. No one's ever touched it, has no admin key, can't change anything about it. And it does have usage. So, that being said, I think the more complicated protocols get and the more interdependent they get, the more you eventually have to have lots of levers and lots of ways for governance to act. And I think one of the most important things that we're starting to see a little bit of now, but has not totally taken place, is this notion of like fast path and slow path governance. So, you know, slow path governance is like changes that are, you know, important, but you really, really want everyone in the community to like have a very strong opinion on as much as possible. Fast path is these emergencies where it's like, actually, there's something crazy happening and sort of a core group of people who really you know, are the core development team or like very close to them, or people like us, like on the like who will go and update things like changing parameters, kind of calling emergency shutdowns when necessary. And I think a lot of that will end up being somewhat delegated because you kind of don't want to give everyone fast path access. But if you want everyone participating in voting on changes, well, then it has to be slow path, right? Like it's not, humans are just not going to be able to respond that way. So I think a lot of that kind of comes up when it comes to responding to events. I mean, obviously, tooting my own horn here, but I think updating your parameters and monitoring, like you're monitoring usage of your protocol, characterizing what types of users you have, looking at which types of users are moving in, you know, in and out of your protocol, understanding like what they're using it for, having really good analytics, having obviously like in our case, like really spending a lot of time simulating these things and then looking at edge cases. I think that's super important because these are very complex dynamical systems. They're not like Uniswap, I think, was this kind of amazing, like V1 was kind of this crazy, amazing thing that like it's very hard to imagine many protocols that could be perpetually static like that. I mean, that was one of the reasons, you know, it took me a couple of months before I actually believed it was like because like I was there on the day Hayden kind of like, and the maker team at my old office in New York, they actually like had this meetup and they were like announcing it and whatever. And I was like, how's this thing ever going to work? Like, then there are tons of adverse selection, whatever. The same things like all the trader people said, like SBF, who really didn't believe in AMMs until they hit billions of dollars of volume, ironically. And there's some kind of deep mathematical reasons for why. And I think that for some of these protocols, when you can actually find this kind of deep math stuff, and you know, us and a few other people have written a bunch of sort of peer-reviewed papers on this, then it's actually you know, then you can imagine this kind of more static thing. But I think one other important thing is that to remember and to view as an opportunity is that the math and the sort of statistical actuarial formulation for what risk means in DeFi is still an open problem, right? There's, I think there's a lot of similarities to math and risk management you might use in traditional finance, but there's a lot that's very, very different. And I suspect that, one of the reasons I and others are constantly writing these sort of like academic papers is that there is kind of this very new field that has a lot of theory that has not been developed. And I think as things evolve and that theory gets better, risk management will get encoded. Some of the results of those papers will get encoded into the protocols over time, and that will make them more resilient because they have these sort of really good provable guarantees.
Great. Yeah, thank you for sharing your thoughts there. Definitely agree. This is like so fast developing, right? It's like kind of combination of finance, high frequency trading, but also engineering. So it's like it's crazy the speed of growth in the field.
Yeah.
So great. I would just want to open the floor for questions. That being said, I'll let Omar ask the first question.
Great, thanks, Kun. Hey, Tarun, thank you for joining us. My name is Omar. I'm a former congressional staffer. I used to work with these issues on Capitol Hill, and it is as bad as we think over there. And I'd like to get your first thoughts on what you think the crypto community's priorities should be when we're thinking about what the U.S. government's next moves are going to be. Because we're going to have to start lobbying Congress one way or another. We don't want what happened with Web 2.0 to happen to us. So yeah, first thoughts on that, and then any quick thoughts on Olympus DAO and that sort of scheme.
Yeah. So for the first part, I think a lot of people are lobbying. I'm not sure how effective they are because lobbying is above my pay grade. I don't understand how it works. And I definitely think there's a whole consortium of people doing this. I think one interesting statistic that I had heard, there's this whole kind of like anti senators trading because they have inside information thing going on right now. One thing that I saw without any proof, so like this could be total FUD. I was reading some article that was claiming this, and it was a reputable news source, but I don't know how they would have gotten this data, so I don't know how I believe it. But they claimed that like 40 members of Congress owned crypto. 40 Senate, not even Congress, like 40 members of the Senate owned crypto. And so I think the interesting thing is like if the kind of dual thing of this insider trading thing is like if enough of Congress is benefiting from it, then that is something that's kind of an interesting thing. But yeah, I do think like the US government probably is like, I'm sure they will do something with stablecoins. I do think that they seem quite incompetent in some ways. And part of the reason for that, in my opinion, is that the US government doesn't really do any of its own technology stuff anymore. It relies on vendors. So it like outsources almost all of the, like, the IRS doesn't have its own development team. The IRS just outsources tracking taxes for crypto and other stuff to other companies who are just not really that incentivized to do more than the bare minimum oftentimes, right? And so I think one interesting thing is like everyone's worried about stablecoin regulation, but Facebook and Novi were just an easy target to just slap in the face in a lot of ways, right? Like they're just so, everyone hates them, and like on both sides of the aisle, like they're just kind of like reviled in so many ways. Also, all of Facebook's revenue and user growth seems to be revenue growth and user growth comes from like outside the US. So it's like there's like a lot you can make tons of reasons for why Congress hates Facebook and Novi was doomed from the start and stuff like that. But I think it's actually way harder for like the USDC type of stuff because again, it relies on the US government getting vendors who are able to kind of enforce a lot of its actions. And I feel like that might happen, but the vendors are going to be slower than the new stablecoin growth in some ways. And so I would say I never what's the phrase? Never ascribe what could be to malice. You should always think like incompetence first before thinking malice. And I kind of think that's pretty true here because of this fact that like the US government doesn't do any of this stuff itself. And with regards to Olympus, I think Olympus is a great liquidity management protocol. It's not a stable coin. 3.3 is a bad meme and is not mathematically does not mean anything. But the core contracts have some very, very cool things that I think are a novel mechanism in crypto.
CK.
Yeah, thanks so much, Tarun. It's a lot of really good information. So with tokenomics being, I guess, such a pivotal part of most projects, kind of curious as to your thoughts as to whether like smaller projects, or I guess most projects that are trying to start out, if they aren't experts in tokenomics, do you recommend that all of them go and get some kind of, I guess, consulting in the area? And also, like, what kind of budget should they be looking at? Because I know for some folks, they're bootstrapping their protocols, they're trying to figure out what the right, I guess, tokenomics setups are, the right incentive structures, but that could be crippling if they don't get that right. So just kind of curious as to what ballpark some of these people are, I guess, should be looking to spend. And also, I guess, how, like, is it okay to just kind of figure it out on your own and kind of bypass that?
Yeah, I mean, I would definitely argue that tokenomics consulting is 90% snake oil and like 10% maybe useful. I think most of the greatest things that have come either from teams doing their own sort of like simulation diligence, things like that, or sort of investors kind of really helping out, because investors have they have had skin in the game in a bunch of different tokenomics systems and can tell you what to avoid. But I think a lot of the people promising consulting it's oftentimes, I would be a little more dubious of the value unless you can see an explicit system that has worked. I think it is better to do incremental stuff and then over time improve things and making sure things work. And if you're very worried about it, one very simple form of governance, I guess not legal advice, is you could actually just have NFT governance where everyone's identity is an NFT who's allowed. And then at the point at which you feel like you need the token to be liquid, you write another contract where everyone burns their NFT and then receives the initial distribution. So that way people have some sort of notion of we can vote using our NFTs, and we can sort of gate certain functions in the smart contract based on ownership of certain types of attributes in their NFT, which is what a lot of token governance does help you do, until you're at the point that you're ready and you've thought through things and you've looked through what revenues you have. But there is some very useful tokenomics stuff, right? And I think a lot of investors are starting to try to like figure out if they can codify what they've learned. But there's no theory, or like no, like, not even theory is too strong a word. There's no generally accepted set of heuristics that will work for every case. And experimenting and being able to fail and then try again is like really important. So to the point of Olympus has changed their token economics like 20 times, probably more, right? And they still were able to attract so much capital to it. So I would definitely go down the experiment route. And now, like, when it's something related to risk and when it's something related to like user acquisition, once you're sort of larger, then I agree that it's more, it should be done very carefully. But I do think if you're like really, really nascent, don't overcomplicate it. You're not going to get it right the first time anyway.
Okay, thank you. Brandon?
Hi, Kun. Thanks for organizing. And Tarun, this was a great call. I really appreciate it. My question is about investment DAOs. So I'm curious on your view on designing like the optimal both tokenomic and also sort of governance structure for that type of DAO. And maybe some examples that you've seen in people who've done it well and people who you don't think have done it as well.
Yeah, that's a good question. So when you say investment debt, do you mean like something in syndicate, or do you mean like a custom one, or do you mean something that's more like multi-sig plus group chat? Because
I mean,
there's a range of sophistication and different types of investment debts.
sure. Like for example, like Syndicate, I know they have a DAO like called like the Komorebi Collective and like Audacity Fund, like which is investing in like Black founders and female founders, like a DAO like that that's sort of making off-chain investments in startups, and have big goals, but still pretty small.
Yeah, I think honestly for those, it depends. Like, it depends on how you want to do the revenue sharing. So like, do you structure that when it's off chain, right? Like, you're still relying on the trust of like whoever the multi-sig holder is, to like whoever is the one who's realizing the, like, whatever the physical entity is that's buying equity to realize whatever carry and fees and stuff. If it's only investing in tokens, I think then the models that you see in the aggregators like Yearn are not terrible, right? Where they do have just sort of some notion of performance fee and management fees. But I would say from the perspective of like the token for voting on investments, I would not add inflation initially, and until you actually have some realized carry and realized revenue, because adding inflation seems great. It's like a way of getting new investors put more capital in. But at the same time, people who are earlier have less incentive to vote and participate. That's like one thing I've observed. So like as an example, I'm in one DAO that's like that, which is Pleaser DAO. And we've bought a lot of pieces, some on chain as NFTs, some off chain, like the Wu-Tang Martin Shkreli album. And I think our token is very simple, and we basically just use it for getting new investors, and also for membership to like artists. So like giving it to artists who we want to sponsor effectively. And I feel like that has been fine, and we didn't really complicate it and provide liquidity and do all the stuff, and it has worked reasonably well. But I think for something like Syndicate, if it's investing in a lot of on-chain things, a traditional management fee, performance fee structure, it seems totally fine. And the inflation of the coin should somehow be tied to the performance. So like, if it's returning a 3x multiple, then like your inflation should somehow reflect that as well.
Got it. Thank you so much. And just out of curiosity, for the Pleaser DAO, like, do you guys like have like a minimum, like in terms of like, do you have to have like 60% of people support it? At least like and some.
We do have delegation.
Okay.
So people do delegate. And so then there's like sort of a core group of people. I mean, Pleaser DAO is interesting in one way, in that it's a DAO that has like probably like 10 employees.
Okay.
Like, it pays people. We pay people in stable coins, like streaming. So that part is actually like, yeah. So I would say that there is actually like a core team that's working, and then there's like a bunch of investors, and like only on really big things does everyone have to vote. So like, if we're buying a piece of over $1 million, for instance.
Got it. Okay. Thank you.
Thank you, Brendan. So we have about 3 minutes or so left. So I have 2 questions. I want to make sure Pong and Aman, you ask your question. So maybe you have a quick question. Go ahead.
Hi. So it seems just like most bull markets, right? A lot of projects are sort of primed for early high valuation. Essentially raise funds and then executes thereafter. You mentioned, I guess you touched on this a bit when you in your answer to CK, but you mentioned NFT governance models. But with something like the Bored Ape Yacht Club with an already ingrained community, do you think it'll be easier, maybe easier is not the word, but to transition such a community into a DAO format where governance principles or framework is voted and contributed by community participants? So I just sort of thinking out loud, you can hold electoral elections for community voted roles or or roadmap intricacies, similar to how governments currently work, but obviously more efficient. And as opposed to starting directly as a DAO, where you might start with a more centralized infrastructure with maybe, as you mentioned, a multi-sig vault of treasury and a more centralized distribution of governance tokens or native tokens.
Yeah, I mean, that's a great question. So, I mean, to the extent I was talking about bootstrapping from NFTs and then moving to governance, one thing that actually might also be a way of doing this is like if you have a bunch of people who collectively own an NFT and then you fractionalize it and then you turn the fractional shares into the governance token. So there's sort of this other way out, which is like instead of starting sort of liquid and fractionalized, you start with like sort of this single identity admin key, which is the NFT. And then at some point you fractionalize and go the other way. And I think for Bored Apes, they're going to have to do that, except the problem is they have a big NFT supply, of course. So instead, they're probably going to have to do something like the following. Airdrop Bored Apes holders the Bored Apes governance token, and then have a staking mechanism where if you stake, you have to lock for like a certain amount of months, and then you get boosts for participating in certain ways. And then that way that gives people who are like, I don't care about governance at all, and I don't give a shit, I just want to be like an ape collector, to just sell their tokens. And then those who want more governance rights to buy them and stake and then like have boosters. I think one of the reasons the Curve Wars even exists is because Curve has this kind of continuously parameterized boosting mechanism for how much more you get for the longer you lock up your asset. And I think like for communities like this, that's sort of the natural thing to do, is to have some sort of duration mismatch. Like if you have different members of the community with different amounts of duration demanded, then making sure that you provide options for all of those to kind of hit an equilibrium.
Okay. Thank you.
Thank you. Pong, can you unmute yourself? Go ahead, ask a question. Can you unmute again?
Hi. Yeah, I was wondering about your thoughts on private governance and whether you think there's any importance to that. I mean, obviously, if it's public, the kind of social pressure can influence your decision. But if it's private, then there's also less accountability. And also, if you have time, I'd just love your opinions on quadratic voting.
Yeah. So I think there's a lot of value in private governance, actually, but sort of in a weird way. So Constitution DAO, of course. So first of all, personally, do not count that as a real DAO. It's a multi-sig with a group chat. It doesn't have like a governance module, like a lot of the things that have actual codified governance with their token. But basically, I would say the interesting thing, right, is they had a ton of adverse selection because everyone knew how much money they had, and you just had to bid $1 higher, or, like to effectively win, right? And so this is a common thing in DAOs. So for instance, in Pleaser DAO, we had this happen a lot where we were like bidding, and then people would see us and then like try to bid higher to like force us, basically like either the artist or a proxy of the artist would start bidding higher than us because they know we would chase, and then it would like push up the price, right? And one interesting thing is this idea of like private governance, but then you commit reveal. So you execute the governance action privately, but then later post it publicly after some time interval, because that way you get transparency, but it's like you reduce the adverse selection cost of being completely public and everyone front runs you in the mempool. And I think that trade-off surface, like that space, is actually quite big, and doesn't have this sort of like you kind of can go between the two extremes you highlighted, if that makes sense. And yeah, it hasn't been explored. I mean, partially because the technology is not that great for doing most of the private stuff right now. But maybe the next 2 years, I think private rollups, I think like Starkware and places like that will probably see some experiments in this first. And quadratic voting, I'm just not the biggest fan, because like any of these kind of mechanisms like this. Oh yes, Aztec. Yeah, exactly. Yeah, Aztec, ZK Sync, Starkware. Like that's where all these experiments are going to happen. Not on any of the other layer ones. But I don't think any of these like reapportionment mechanisms, you can prove they all basically are not Sybil resistant. And there's a sense in which, yes, sometimes you're fine with that trade-off, but like that trade-off is not constant. There might be some votes where you want more Sybil resistance and some votes when you want less Sybil resistance due to like a certain amount of financial incentive in the thing being voted on. And I don't think quadratic voting parameterizes that correctly, where you can kind of have a notion of like the importance of a vote. You know, the parameters in quadratic voting don't do that. And so hence you get this like very Sybil not resistant thing all the time. And you know, like I said, it can work to some extent, but you had a lot of, you know, there was a lot of sort of like influencer marketing style stuff that has happened in Gitcoin to take advantage of the lack of Sybil resistance. And I think that's a great case study for someone to analyze if they want to kind of like say, here are the pros and cons of it, like as an empirical analysis of GitHub or Gitcoin, sorry, because that's probably the most used quadratic voting thing, period. But yeah, I would say like reapportionment is fine, like of like giving boosters depending on size. I mean, you know, like I said, there's kind of the boring math proof of like why you can never be Sybil resistant or not Sybil resistant if you're not sort of like linear. But it doesn't get to the point of like, hey, there's, you know, varying levels of that needed.
Great. Thank you so much, Tarun, for coming here today and sharing with us some of the framework and considerations and some common mistakes in design tokenomics and answering the questions from the students. And we'll have office hours for the incubated startups. You have the more, obviously designing tokenomics should be like more kind of specific, maybe like custom tailored towards the need of a specific protocol, given the type of protocol they are, or the market they're in, lending or NFT. So we'll host office hours with a Gauntlet's team to kind of give more specific advice. But today is a great kind of starting point of general framework they can potentially use for as a starting point. Yeah.
Awesome.
Thank you so much, Tarun, for your time. All right.
Thanks.
Yeah. Bye-bye.